Happy Monday, everybody. I hope you had a great weekend. Last week was another week of records. We're going to get to that in just a moment. Today is October 21st, 2024, and this is your Monday market update. Happy birthday. This bull market turned 2 years old last week on October 12th. The performance of the S&P 500 during the first 3 quarters of the year is the strongest since the late 1990s. If the index holds on to its 20% gain until the end of December, it'll be the second consecutive year of 20% plus gains. That's the first time it's done that since 1998. As we do each time this week, let's review last week and let's preview the coming week, and let's jump right in. Markets ignored eco data from China on Monday and extended the prior week's gains. We saw mixed action across the sectors. Tech stocks led the way, with NVIDIA, of course, hitting new record highs, up 2.5% to close as the second most valuable publicly traded company in the U.S. Earnings are still in the menu, and still mainly the banks, and the markets were focused on these earnings. As I've been suggesting for the next direction of the markets, that's where I think that we're going to continue to focus. Volumes were low as the Columbus Day holiday had bond markets closed and some people home. News wires were quiet, so momentum kept things moving on the upside. Oil fell by about 2.25%, closing under $74 a barrel, pressured by concerns about the sluggish demand from China and OPEC Plus cutting its demand estimates for the third consecutive month. Geopolitics concern also had an impact, especially as the Israeli-Palestinian conflict remains in focus. However, markets shrugged off any major escalations, and reports indicated that Israel would not strike Iranian energy infrastructure, which helps stabilize the global energy markets. As we move further into the week, investors will keep their eyes on corporate earnings, especially from tech and financial giants. The ongoing geopolitical tensions and economic data from China will also play a key role in shaping market sentiment. On Monday, the Dow closed up about 0.5%, S&P up about 0.75%, and the NASDAQ by almost 1%. Light trading also often magnifies moves, so momentum, of course, ruled the day. On Tuesday, markets hit an air pocket, at least it felt like one. The move seemed to be driven by disappointing economic data and negative news from the technology sector. The Empire State Manufacturing Report showed most business activity metrics in the negative territory, with inflationary pressures from rising prices contributing to fears of stagflation. So yes, that stagflation word is back. Is Powell seeing that now? This one had something for everyone on the bad side. Lower growth, higher inflation. This is only one report, but at these levels, markets are not pricing in any slowing. So not to mention stagnation or recession. Tech news did not help, as news that the U.S. government might limit AI chip exports, particularly affecting NVIDIA. It hurt the sector. We also got a report from semiconductor stock ASML with disappointing earnings and lowered its outlook, which further dragged on the tech stocks. Earnings from luxury retailers like LVMH and COTY revealed weakening consumer demand, continuing a trend seen in lower end consumer sectors. Remember, the consumer does matter. They're nearly about 70% of our economy. Oil prices dropped sharply again, falling almost 4% to $71 a barrel. There are many forces that are at work here. Lower growth outlook, OPEC Plus willing to add back capacity, as I mentioned, and another day without major news from the Middle East. Overall, Tuesday's market action reflected broader fears of a slowing economic growth amid inflation pressures, with mixed signals from corporate earnings exacerbating market uncertainty. The Dow and the S&P both closed down about 0.75%, and NASDAQ closed down about 1%. On Wednesday, markets opened flat. Sideways movement was in the air, and 2 prior days had to be digested. Again, it's not normal to see everyone moving from one side of the boat to the other. We've talked about that a lot, but not so quickly. There is a bit of rotation to small cap and to value. Drilling down a bit, utilities and financials performed well, with the utility sector rising about 2% on the day, helped by cooling inflation expectations and lower bond yields. On the other side, energy stocks lagged, with oil prices attempting to stabilize around that $70 a barrel level. On the eco side, a lesser followed import and export prices report showed easing inflation pressures in September, which sparked dovish money flows. More eco data coming up. Hold on tight. Earnings reports were a strong driver of market sentiment, with approximately 79% of S&P 500 companies reporting better than expected earnings. I have to report that this way, but that is 79% of a very small subset of companies at this point. Remember, it's still early. Even so, directionally, things look good. The Dow closed up 0.75%, new record close. S&P up about 0.5%. The NASDAQ was up about 0.25%. On Thursday, the market was driven higher initially by strong tech earnings, particularly from Taiwan Semiconductor, but these gains were offset by strong economic data, specifically lower than expected jobless claims, solid retail sales, which of course diminished hopes for an aggressive Federal Reserve rate cut, which tempered optimism for the aggressive cuts that people are pricing in. So once again, you see all of the forces at work. earnings versus Fed and inflation. Semis do seem to be the one that is the main driver of the markets at this point. That did help things overall. It just did so relatively quietly on the day. Strong data was on a few fronts. Initial jobless claims were lower than expected, and retail sales exceeded forecasts, reinforcing the narrative of a soft landing again for that U.S. economy. U.S., However, as I mentioned, this data has also raised uncertainty about the pace of future Fed rate cuts. There was an article over the weekend asking if the Fed jumped the gun and cut too soon. Funny, because the calls for a cut and how late they were, those were so loud. As I mentioned, from one side of the boat to the other, markets make that move. Pundits are not far behind. They may even lead the charge. Energy stocks led the market, followed by tech and financials. Oil managed a slight recovery, closing at $70.76, ending 5 sessions of losses. To close out the day, the Dow was up about a third of 1%, S&P down just a small bit, and the Nasdaq was up a small bit. Friday markets opened slightly higher. Netflix earnings were out. Thursday night drove tech money strong on the positive side. Housing is still a bit slow. Needed evidence that the market is not overheating again. They'll take that at any point to show that. So remember that broadening out of the market we're looking for. As of Friday morning, 38 S&P 500 stocks were at new 52-week highs. That's a lot better than just 7. So we'll see how that goes. Overall, markets were moving on earnings and eco data, finishing the week strong. The Dow and the S&P at new highs. The Dow up just under 1/10%. The S&P up about 0.5%. And the Nasdaq was up about 2/3%. For the week, market down 6 straight positive weeks, longest streak this year. For the week, the Dow was up almost 1%. S&P up over 0.75%. The Nasdaq was up almost 0.75%. Earnings, about 70 S&P 500 companies have now reported so far, and they're in line with long-term averages. About 75% of them have beaten expectations. We're in an election year, and regardless of long-term implications, which usually are minimal, stocks have historically been hesitant into elections. Markets now are rallying into elections. As I've said, we live in historic times, so we'll see how that goes. Let's preview this coming week. We'll get a lot of Fed heads. That's the headline, or will it be the same? That will be the same old story. Recall that we often get the Fed heads to float some ideas to see what markets think. Maybe we'll see some step out and try to see what the markets think if we get less than the 2 cuts markets are expecting. We'll hear from Logan, Kashkari, Schmidt, Daly, and that's just today. Harker, Barkin, and Hammock, they will round out the week. We'll get the beige book. That's a little followed one, but it does bring some good data to the table. PMI also. We'll get labor market reads with jobless claims, and we'll get University of Michigan numbers on sentiment and inflation expectations. I think the big watch will be on earnings. Some of the big names this week that may move markets: Tesla, Amazon, Coke, Verizon, AT&T, T-Mobile, and Boeing. We'll also hear from UPS and Union Pacific. We're going to see if anyone wants to read into their earnings like they did FedEx. Remember, if consumers are still moving things, UPS and Union Pacific, they'll know. So will we get a consumer read from them? We'll have to see. Watch for news from Vegas. It'll be a mix. There's a healthcare industry conference started yesterday, and watch to hear from Google, Nvidia, and Microsoft, to name a few. What will they do at a healthcare conference? AI, of course. What can AI do for healthcare? This is something to watch. I imagine to the positive. You think they'll show up just to say, sorry, we can't help you right now? So I doubt they'll do that. I think you'll see some good news come from there. Let's see how this week goes. Remember, I maintain that there are 3 main risks to this market in this order, in my opinion. First, valuation. Yes, the news will be good, but how much of that's already built in? Second, geopolitical, not a quiet world around us. And finally, the U.S. political campaign. Getting down to crunch time, something's going on when the vice president is going on Fox News and considering a Joe Rogan visit, and Elon Musk is out on the road for Trump. You could not make this stuff up. Overall, keep your eyes on the long-term goals, stay nimble, and let's start to plan for any year-end moves that we'll need. Wednesday will be the next planning video again, since Thursday and Friday are Jewish holidays again. Last major ones for a while. Have a great week, and let's keep in touch about year-end planning.